there needs to be something else in a portfolio to help manage risk. And that's really where buffer ETFs come to play in today.
Most people think that if you want to get growth in your portfolio, to do that, you have to take risk.
The way that people manage risk differ from advisor to advisor and client to client. This is what buffers are built to accomplish.
It seems like this gives us a little bit more upside compared to things like bonds or annuities or cash.
So even in this environment that we're in, where we have rapid sell-offs preceded by rapid recoveries, a buffer ETF can still be a great tool. What happens in a recovery period? These products actually respond well to more volatility.
Today, we're joined by Michael Capizzi, Managing Director at Vest. Vest is a firm that specializes in structured investment strategies, especially defined outcome ETFs or buffered ETFs. Now, buffered ETFs have grown in popularity over the last 5 or 6 years, and they're designed for people that are approaching retirement or in retirement that want two things at the same time. They want a downside protection when the markets are volatile, but they still want upside growth when the markets continue to grow. Michael has joined us today to break down all the myths, the misconceptions. He brings a unique perspective from the inside. We're going to dive deep, go over everything you need to know about buffered ETFs, the benefits and limitations. This is going to be a great episode. Stay till the end. Let's dive into it. All right, Michael. One of the first questions I have for you, for someone that's watching this show, is for someone that's listening to this on our podcast or watching on YouTube that is unfamiliar with what a buffered ETF is. How is that different from like a traditional ETF or a mutual funds?
Sure, David. As far as the buffer ETFs are concerned, now the vehicle is still the same, right? As far as an ETF vehicle or a mutual fund vehicle is concerned. But I think traditionally a lot of investors are used to, as it relates to ETFs and mutual funds, having a little bit more of a plain vanilla approach, meaning you have, an ETF that has exposure to something like the S&P 500. You have fixed income bonds that may be, exposed to something like the ag. Whereas inside of that ETF wrapper, we're going to do something a little bit different. And what we're doing is we're trying to create, and we'll talk about this throughout the course of today, I'm sure, a very targeted or defined outcome. And those outcomes can be different timeframes, but let's use 1 year as an example. The way that buffered ETF would be constructed is basically to provide exposure to a handful of different underlyings, but let's use the S&P as an example. And we'll still get that S&P exposure like we would in another ETF. But in this instance, that S&P exposure would sort of have guardrails on it. And what I mean by that is there would be, over the course of that 1 year time frame, a defined level of downside protection and also the opportunity for upside participation up to a cap. And so if we hold that product over the course of 1 year, what's different about it is that we're going to have that knowledge that we know sort of what's going to happen towards the end, because we know what our cap is, we know what our buffer is. And so essentially at the end of that 1 year period, wherever the S&P ends up, either we participated in those results up to that cap. If the S&P was down over that time frame, we sought to protect against those losses. And if it goes beyond the buffer, then maybe we participate in losses thereafter. So it's a little bit different. Think of it almost kind of like a structured ETF compared to something that's long only S&P or long only fixed income.
Okay. That makes a lot of sense. So like when we meet with, retirees or pre-retirees, north of $1 million that are really close to retirement or approaching retirement, when Vest, which is one of the leaders in buffered ETFs, when your company decided to, what kind of was the thinking of why were these ETFs created? Was there a specific investor concern that kind of prompted the thinking of making these, strategies? Because this is really different, because most people that we meet with, their risk exposure is really high. I think most people think that if you want to get growth in your portfolio, to do that, you have to take risk. But with buffered ETFs, yes, there's still risk, but like you said, there's some downside protection, but there's also, a growth component to what as well. What was the thinking when, these strategies were being thought of and being creative?
Sure. Well, I think first and foremost, the genesis was the fact that concepts like these have been around for a long time in different vehicles, right? So I'm sure investors are familiar with things like annuities, things like structured products. In the pension world, these type of solutions have been around a very long time. So really the ambition and the inspiration was first and foremost to bring the products downstream to the everyday retail investor in a vehicle that may be easier to access. And so by no means am I referring to anything as it relates to annuities or structured notes, but just speaking to the fact that ETFs are very digestible for everyone, right? You can go into any brokerage account or you can work with your financial advisor and get access to these products. So first and foremost, I think it was accessibility. The second thing you already sort of teased a little bit, which I think is super important, is while these products can be a great complement to things like an annuity, to things like a structured product, really the idea was that we wanted to produce a third leg of risk management. And what I mean by that is, oftentimes we have conversations with advisors throughout the country, and the way that people manage risk differ from advisor to advisor and client to client. But very often the feedback is, well, we utilize some degree of diversification to manage risk. And that's great. And it works really well a lot of the time. We have our equities for growth, like you mentioned, our fixed income, which can be our ballast and also provide yield. But when you need something else, this is what buffers are built to accomplish, right? And so you think back to a year like 2022, where interest rates were going up and you subsequently saw equities going down in light of that, as well as fixed income. That was really sort of where buffer ETFs can make a great place in a portfolio to help manage risk. And so it'll differ based on the risk tolerance of the client. You mentioned retirees as an example, but also younger clients, the amount that you want to utilize can be differentiated. But at the end of the day, the concern that we had was that basically, if you go back to the tech bubble and pre the tech bubble, the correlation between equities and fixed income was completely negative, meaning that your portfolio, your 60-40 worked beautifully. Ever since then, there's been these blips on the radar where equities and bonds are actually highly correlated, whether that's positive or negative. Either way, that means that there needs to be something else in a portfolio to help manage risk. And that's really where buffer ETFs come to play in today. So it was first access, but now a new way to manage risk.
Okay, great. I want to get, and I've got some questions directly about 2022 because I've been doing this 26 years and it was the first time in my career that I saw both equities and fixed income at the same time negative. And that really kind of made us rethink how we, structure portfolios, or made us really rethink how we, offer a risk management tool. But we've mentioned buffers and it's capped. I don't think I've done a good enough job asking you the question, how do they actually work? First of all, when you say buffer, what does that mean? What's buffered? And then when you mention a cap, what does that mean and what's actually capped? If you could break that down as simply as possible for the audience, I think they would enjoy that.
Yeah, absolutely. So first and foremost, let's start with sort of the different components of the product. So you have your exposure to the S&P 500. That's something that we're all relatively used to. You can get exposure to tech, EFA, you name it. We probably have a product like that. However, let's talk about what is a buffer, right? That's not something that everybody knows what that is, traditionally speaking. So what a buffer is, I like to think of it really simply put as an eraser. And so when you have a buffer in place, and let's say it's a 10% buffer, and over the course of a 1-year time frame, if the S&P is down somewhere between 0 and that 10% buffer, think of that buffer like providing an eraser potentially for reducing those losses between 0 and -10. That's really what a buffer is. It buffers that downside. And then beyond the buffer, you will generate some exposure to the downside thereafter. If the S&P goes down farther, right? Your eraser is only so much, right? It only has that first 10% downside. However, the buffer can be 10%, it could be 15, it could be 100% in some cases. But nonetheless, I like to think of the buffer as an eraser for layman's terms. And then on the upside, there's this cap in place. And why is that? Right? It's a really key part of this process. And the reason is because we want to provide you that protection. But like anything else we talk about there not being a free lunch, right? In a lot of different instances, right? We can't just give you downside protection and full upside. Something has to fund that downside. And so the way that we construct the portfolio is if we want to put on a 10% level of protection based on the current market environment, we're going to put a cap in place, which is going to essentially pay for that protection. So let's just say this past Friday, We had a 10% buffer that we created or we reset. We put a 10% buffer on it. In the current market environment, that produced a cap of 14% on the upside. So what that means is that over the next 1 year, we already understand that we have that 10% protection or eraser. What that means is that on the upside, if we have S&P 500 exposure, we're going to seek to provide on the price returns of the S&P up to that 14% cap. So if the S&P returns price return wise, anything between 0 and 14 will participate in that before fees and expenses. And then anything beyond that, we're going to be capped out from. So that's why that cap is in place. And it plays a crucial role to essentially fund that downside protection.
That's sorry. We got more questions because we meet with clients all the time, and when we present that to clients, the first thing we get was, "Wow, that sounds too good to be true." Because I think clients' exposure is like, if you want risk management, these are the traditional tools. You mentioned annuities, right? And annuities can be great tools for the right person for the right reason. But a lot of limitations are there's liquidity issues, or you're not going to get as much growth as that you mentioned within a buffered ETF. Then you have fixed income, and fixed income has been a traditional strategy that advisors like us use to manage risk. And we can go back to 2022, where the traditional 60-40 portfolio was completely down, right? We had 4 interest rate hikes. We haven't seen interest rate hikes in a very long time. And you hear all about all the time, hey, the bull market in bonds might be over. And we're a buffered ETF. So let's go back to 2022. The S&P 500 was down over 20%. So what you're saying is if you had a 10% buffer or a 15% buffer ETF in 2022, if the market's down 20 and you had a 10% buffer, you would specifically be down only 10. Is that correct?
Yeah, that's a fair way to put it. I think important caveat to mention, of course, is that, and I think we'll get into some of the more educational part of this and understanding how the products work. But one of the key caveats, of course, is having owned that throughout the entirety of 2022. If you had a 10% buffer and the S&P was down 20, basically that first 10% of losses would be buffered against. And then you'd be exposed to the next 10%. So in 2022, in that example, S&P is down 20, we have a 10% buffer. We would expect before fees and expenses to be down just 10 compared to what the S&P 500 did.
Yeah, and then you still get some upside, because a lot of times I think when you are saying, hey, I want protection, immediately you're limited on the upside. And what it sounds like with the buffered ETF, there is more potential, obviously, to still have that buffer, but to get a little bit more upside when you're maybe, and I say we're not comparing this to or saying, hey, own a buffered ETF instead of this, but we're saying when you look at all the risk management tools out there, it seems like this gives us a little bit more upside compared to things like bonds or annuities or cash or other risk management strategies. Is that fair to say?
Yes, certainly. It's fair to say. And I think that's one of the other, reasons, the ambitions behind bringing these products out. Because one of the things is when it comes to other forms of risk management like annuities, one of the things that the advisor and the client have to do is you're really transferring that risk over to like an insurance company, let's say, right? And so it's really nice in this context to be able to keep those assets in-house with your financial advisor who you trust and build it inside the context of a model portfolio that you already have with the advisor. So it makes things pretty easy. But the other thing that you mentioned is the upside. One of the nice things about buffer ETF products is that we're not deciding what your upside's going to be because we have some other, motivation behind where the cap is going to be and us benefiting from where that cap is going to be. Sometimes the cap is really good. Sometimes it's a little bit lower. All that's based on are the current market conditions. And the reason that you see oftentimes what I like to call an accordion effect. And this accordion effect is that let's use 2022 as an example again. Market's down, right? S&P 500 is down. What also tends to correspond during that time frame is that volatility tends to pick up. And to not get too granular here, but I think clients will appreciate this, is that these products actually respond well to more volatility. They actually respond well to higher interest rates. And what I mean by that is all the while in 2022, while you're being hedged, you said these products are sort of too good to be true. Well, the part that's not too good to be true is, okay, well, what happens in a recovery period if I'm capped out? That's the give up, right? That's where it makes it not too good to be true. We have that cap in place. But what's nice in a 2022 environment or other environments like during COVID back in 2020, or even when volatility picked up in 2018, is that the caps respond positively to higher volatility. So throughout 2022, each of the caps that we're resetting throughout that time frame are coming in really high all of a sudden. So maybe they were at 12 or 13% going into 22. Well, now with volatility having picked up, now they're coming in the high teens and the low 20s. So the products are going to respond well. And what's nice about that is that you had your downside protection in 22, but in 23, you didn't want your downside protection. You wanted your positive returns. And what these products were able to do, it's not going to be perfect. You're still going to underperform the S&P 500 in a 2023 environment, but you still got a lot more upside than you would have because the products were able to basically monetize volatility and provide higher upside caps.
Yeah, and we talk to clients all the time that are in wealth preservation mode. There's this quote that I love by Warren Buffett. It says, "It's crazy to risk something that you have for something that you don't need." And I think really what this gives pre-retirees and retirees is just another option. If your goal is to, manage wealth preservation, manage volatility, I think these are good strategies to potentially look at that could answer that question. Is like, David, as I'm approaching retirement, how should I look at my portfolio? I'm no longer working. I'm not in those accumulation years. I'm in distribution years. And, I still want growth in my portfolio for things like inflation, higher taxes down the road or whatever it's going to be. We'll show this chart here. If you look back over the past 30 years at the S&P 500, there's been an average annual drawdown of about 14.5%. So I think what most people lose sight of is like since 2008, 2009, we really only had COVID, which bounced back really quickly. And then, like we've mentioned, 2022 was the first real, negative year that we've seen in a long time. And it was also unique where bonds and stocks were negative. If there's an annual, volatility, if there's an annual drawdown rate of about 14 or 15%, I mean, talk about that where buffered ETFs could potentially, be a place in someone's portfolio because now, April was bad. From January to April, we saw the markets draw down, right? And ever since April, it's almost been a straight line. Talk about again, buffered ETFs, how they could really complement someone's portfolio when annually we see anywhere from 10 to 15% drawdown in the S&P 500.
Sure. Yeah. And I think it's a really good point. You're sort of also alluding to the fact that we've been in an environment that we may be going into the future into a little bit of a different environment potentially. And when you talk about folks that have gone from your accumulation phase to distribution phase, these products are a great pairing for their portfolio. They're not the type of clients, at least from what I see throughout the country, that are looking to outperform the S&P 500 or outperform tech. Really what they want to do is, protect that nest egg. And to your point, throughout any year, even a year like this one, where I think it looks like we're going to end up positive, you still had a pretty significant drawdown. And sometimes it's easy to forget that. And what's nice about a buffer ETF product is I think everyone has seen these sort of graphics. And maybe this is the graphic you're alluding to, David, where you see these periods of time where if the market were to sell off to a certain degree, it's not always one-to-one coming back to get back to where you need to start from. My point being, if the market's down 10, well, what do you need to get back to zero? The more that drawdown is, the more you need to come back to recover. And what's nice about even a year like this year, where if you had owned a buffer ETF, even a buffer ETF that wasn't all the way through its target outcome period, these products are built to still have some degree of, volatility compression and sort of providing lower volatility. Let's say from, March to April, the S&P was down 20, your buffer ETF is still seeking to be down significantly less than that. So what that means is you've taken part of the portfolio which no longer needs to come back as much as it would have needed to otherwise. So even in this environment that we're in, where we have rapid sell-offs preceded by rapid recoveries, a buffer ETF can still be a great tool because it's supporting however much is in the portfolio from going down that full 20. Because when that recovery happens now, okay, we're starting from a better place. And we actually have better returns this year using a buffer ETF because we hedged a lot of that downside, even though it was a small window of time. And to your point, there's always going to be that natural 5 to 10%, 15% sell off in a given year, even in a positive year. And these products just help smooth the ride for those clients, right? I mean, you're an advisor and a great one. That's when you're getting your phone calls, usually, I'm assuming. It's not when we're outperforming. It's usually when, okay, what are we doing right now in this market? And you get to tell them, well, we're using these tools that can really benefit you in this environment and still participate in the upside.
Yeah, no, we were on the phone, obviously in April earlier this year, we actually recorded an episode and talked about volatility and how it's normal, but it's really hard to explain that to a client who's actually seen their account statements to say that it's normal. But for our clients in that moment, of course they had, volatility in their stock portfolio because we have clients that want long-term growth. But when we reviewed some of their we'll call it a risk management tool, like a buffered ETF, they're like, oh, wow, this really works, right? Because I think we forget when markets are going up, we're just so focused on growth. I think most investors have, I don't say short-term memory loss, but it's those downtimes that you can really shine as an advisor when you're explaining why products like this could make sense for them. And then when they own it during the moment, they kind of never forget it. And it's something that they're probably going to keep forever because we always remember, the good times are there, but you always remember when something bad happens to you, no matter what, whether it's your financial life, your health or whatever. So I think these products have definitely, I like how you said that, smooth out the ride, because the ride's never going to be a straight line. It's always going to be bumpy. And we always ask clients, if you look at your retirement, like, a vacation or, a long drive around the country, how smooth do you want this ride to be? And I think this is where we start having the conversation of buffered ETFs. You meet with a lot of advisors throughout the country. Is there a segment? And I know I've talked about pre-retirees and retirees, but I want to, kind of get your perspective. Who might buffered ETFs be most appropriate for? And are there specific goals or concerns that these products help with? Again, we've talked about downside protection with some upside growth, but who might, from your perspective, might buffered ETFs be the most appropriate for?
Yeah, it's a really good question. I've been doing this on the buffer ETF side since 2019. And the really amazing thing about these products is just how versatile they are, but also, going around the country and seeing just how different every advisor approaches their practice. And so when I have conversations with, RIAs, places where these products are available, the implementation can be different for everyone. That said, I think that there are some generalizations that we can make. And I think those generalizations, it's fair to say that depending upon the client, depending upon the portfolio, that these products are most certainly very well suited for those portfolios that are on the more conservative side of things, right? As we are, let's say we have a portfolio, one's aggressive, one's moderate, one's conservative. What you'll often see is sort of a difference in the amount of buffer ETF exposure in each, right? So you have an aggressive portfolio, maybe you have 5% buffer ETF exposure. A moderate portfolio, maybe you have 10. Conservative portfolio, maybe it goes up somewhere between 40 and 50%. So that's more from the portfolio perspective. And then the clients that are in those portfolios tend to have a certain demographic, right? They tend to be someone in that aggressive portfolio, that's someone in their mid 30s. They want more upside participation, maybe less fixed income and maybe less buffer. So it's really, I think, a great product for those moderate conservative portfolios for those clients that can't afford a year like a 2008. They can't afford a year like 2022. That's the biggest thing, right? 2008 was very challenging to come back from. I mean, you saw how long it took tech to recover from the tech bubble. What these products are seeking to accomplish is to take the months to recovery and reduce it significantly for clients. So I think those investors that don't have the appetite for those losses, which tend to be those approaching retirement or those folks in retirement, these are really, really good products for. But I do think you can make arguments for many different use cases. Another is and I'll throw myself as this type of client. Just turned 40, and for me, I'm still at a place where I don't know how much fixed income I want in my portfolio. However, I don't want to be 100% exposed to the market. And what I mean by that, the equity markets. And so for me, having a 10% allocation to something like a buffer ETF, that gives me the opportunity to still participate in equity growth, but have protection in the portfolio too. And so you could also make the argument that it allows you to actually take on a little bit more risk. So if you're saying, okay, I
Mm.
own the NVIDIAs of the world, I own a lot of these tech names, and I don't want to sell them, I don't want to deal with the tax implications there. What should I add to my portfolio to avoid the risk of, that sell off? Even as a younger investor, this allows you to stay more risk on for longer. So I know I gave a lot of different answers there, but there are a lot of different use cases. So I don't think it's just one type of client, but ultimately, it goes without saying that a client, I think of my parents, they're in their mid 70s. When I told them about these products, they were in sort of a target date fund for, whatever year of their retirement was, which they had surpassed. And I said, well, mom and dad, what do you think about a product like this? They're like, Michael, this is what we need. We want to just not worry about anything on the downside and also appreciate on the upside. But, we don't understand stock and bond correlations. We don't understand that you're incorporating more fixed income and less equities. We just want something that's going to tell us what's going to happen here. And this is the transparency that these products can provide.
Yeah.
So hopefully not too long-winded of an answer for
No, I think
a pretty big question.
no, I think it's a great answer. It just depends on your risk appetite. I think of my kids are in their 20s, they're 100% of their portfolios all in stock. I mean, they have 40 years before they're even going to think about using this money for themselves. But, 40-year-old, sure, you still want equity exposure. You're still in growth mode, but do we want 100%? And then, yeah, fixed income is, it works, but it's not going to give you generally, it's not going to give you the upside that a buffered ETF is going to give you. So I think that's just great information for the audience, because we have people in their 40s, 50s, retirees listening to it. So it's just not, I'm glad to clarify, it's just not for someone that's approaching retirement. This could be for someone that's still in accumulation mode. And maybe this potentially could be a supplement to fixed income. And that's kind of my next question. Are buffered ETFs designed to replace anything, or are they more of a supplemental tool in an overall diversified strategy?
Yeah. And I don't think we would ever, say, we would say, what's been working for financial advisors historically, keep doing that, right? Like, whether it be in, sort of the 60/40, we can throw that out there, or diversification, that has worked really well for a long time. What this is a supplement to that, right? And so it's just saying that there's going to be flaws in any type of investment approach to some degree, right? Being fully in equities, you take on a lot more risk, right? You take a lot more downside risk. Being fully in fixed income can be great, but we're not going to get as much growth. It's going to be a great balance for the portfolio, and we're going to generate income. Those are tools that are so important for all investors. So we would never say, hey, this is a direct replacement for that, and let's abandon what we've been doing for so long. All we're saying is that here's a new tool for you that can be a really versatile tool for you that can supplement what you're doing. And wherever you see as the advisor in your own portfolio as where there is the need to plug a hole, this can potentially plug that. And that's what changes for every advisor. But, let's just say, there's a client that has, a little bit too much fixed income exposure. And like you said, maybe the fixed income bull market is slowed down. Well, maybe you take a carve away from that and just supplement that, but still have a lot of fixed income. Or it's the opposite, where we have too much equity in a portfolio. And, we've been in this the last 3 years, 7 stocks have driven equity markets for that amount of time, but we don't know when the song and dance is going to end, and we don't want to be the one to call it. So in the meantime, here we are at all-time highs as an example. It's a great time to say, we're not going to take away all of it, but let's supplement some of that with something like a buffer, so we know at least part of the portfolio is going to be protected. So I think that the supplemental approach is great. And I think that provides you, everyone here that's listening, that we do have a very unbiased approach here for where we fit in this industry. We're not here to, take over and sort of abandon what we've done. Keep doing that, but use these as that supplemental tool.
Yeah, I like that because, in my 26 years, I lived through 2000, 2001 and that recovered. And then 08, 09 happened. These recoveries, it depends on the drawdown, but those last, 2000, 2001, 08, 09, it took 5 to 7 years for people's money to recover. Right. And I think for people that are in their 50s or 60s right now who lived through that, number one, you have way more wealth than you did back in 08 and 09. You haven't experienced a 50% drawdown in the market. People have to remember that if the market drops 50%, you need 100% the next year just to get back to even. And I like how you said that what the buffers do is kind of give you a point where if the market's going to rebound, you don't need as much as a rebound for the percentage of portfolio that you may have in a buffered ETF because you had that eraser, or like what we say, like a sponge, right? 10 or 15% drawdown. If I were to ask you this question, what are the benefits and limitations, again, of buffered ETFs in the most simplistic fashion? How would you answer that question?
Yeah, and let me start with limitations because we certainly have spoken a lot about the benefits. But limitations, of course, one that's really obvious is the fact that, if you're in a year like the past 2 years and you are an investor who wants to participate fully in what the past 2 to 3 years have produced for you from an equity perspective, you can't expect a buffer ETF to, go along with that same ride, right? Those caps are in place. Their caps are in place for a reason. And unfortunately, that's going to limit some of your upside if you're hoping for a return that's similar to what we've seen on average the past 3 years. That's one of them. The other limitation, and I think that this limitation is a byproduct of a lot of advantages to the products, like liquidity, like transparency, like being in an ETF wrapper. Those are all great things. But another limitation that I think really takes a lot of education, and it sounds like I'm sure you've had these conversations with your client, David, but they're not going to provide you that buffer immediately. They're not going to provide you that upside immediately, right? These products are built to provide protection over time and upside participation over time. So one of the limitations is, okay, David, great, you got me in a 10% buffer. It just so happens the 10% sell-off occurs tomorrow. And if I haven't had education from you and I just gone on a website and looked at this marketing piece, I'm saying, okay, I'm great. I didn't participate in any of that, right? Well, the products are still going to need that time to fully sponge away those losses, right? So if there is a 10% sell-off the day after you get one of those products, and one of these products, you may still participate in some of that downside. So I think that's one of the limitations to the product, is that it's impossible for you to have liquidity and for you to have it in an ETF, for you to have the best of both worlds where you're getting immediate protection and upside. So that's one of the limitations as well, in my opinion. It's something that I think can be educated away, if that makes sense. And once people understand that, it's okay. However, for someone that's brand new to this, that's a brand new client that you bring in, it's essential that they understand how these products are going to behave. And that behavior is, over the course of that target outcome period, expect to see some growth, not all of it. Expect to see some protection, not all of it. But if we hold it to the end of the target outcome period, that result is going to be what we should expect. So those would be two of the big limitations: cap and understanding the way that they work. From benefit perspective, unfortunately, I think I could go on well past how much time we hear on this podcast, but I think the benefits are, you have a new way to manage risk. That's really sort of one of the things that I like to think about is, in your job, David, you may disagree with me, but you have a lot of different roles. You have to, of course, manage a lot of clients. You have to manage great portfolios, but to a degree, you're almost, a therapist. You're like someone that helps people invest their money. I graduated in 2008 and I'm still affected by that. And I'm young. And I've missed out on so much return in the market because in 2008, I graduated, I lost my first job, and I wanted to put everything that I ever earned underneath my mattress because of what occurred in 2008. You help people like me be able to safely invest their money. And what these products help us to do is that in investing, we've always had to say, okay, diversification, I believe will work for me. This adds a third leg where in the rest of our day-to-day lives, and this is why I sort of bring up the emotional side of this, if I'm worried about my car, I get car insurance. If I'm worried about my house, I get flood insurance, right? But in the context of a portfolio, generally speaking, in that model, we're really hoping diversification works for us. And sometimes it doesn't, like a 2022. So I'm not saying that this is an insurance product in a portfolio. What I'm saying is it sort of gives you the peace of mind that insurance gives us in other aspects of our life. So I think that's a great emotional and psychological benefit. So there's many benefits from an investment perspective, but I think one of the biggest ones is the psychological benefit, the emotional benefit for clients that are nervous or want to have money on the sidelines that when it shouldn't be.
There'll be a day when I'm done working and I don't think about this stuff anymore, but I just can't imagine someone who's worked 30 or 40 years and has saved and sacrificed, and all those people that retired in 08, 09 thinking that, you know, this was easy, right? You just have your money in the market, it's going to do its thing. And overnight, you know, over 12 months or whatever it was, they lost half of their portfolio. There's certain things in life we never forget, right? I never forget when my wife said, yes, will you marry me? I never forget both of my kids being born. But like when you lose half of your net worth that took you 30 years to save, those are things that'll last a long time. And I think, again, a strategy like this, and we're going to get to the defined outcome and some of the things that you mentioned, to just give you peace of mind, I think there's no price on peace of mind, in my opinion. I want to go to the defined outcome. I've been waiting to ask this question. I've heard it enough times from you now. The audience is probably thinking, okay, what is that? How long is a defined outcome period typically? And what happens at the end of that period? And also if you can answer that question when you said, hey, if there's a period of time that you want to own one of these strategies, can we dive deep into that so the audience understands that, yeah, these aren't, you buy it and all of a sudden it works exactly like we said. You've got to give the strategy time because there's, mechanics within it. Can you answer those questions?
Yeah, absolutely. So as it relates to the target outcome period, historically and traditionally, that target outcome period is about a 1-year time frame. I will say that we built products now that will reset after 3 months. We have products that'll reset after a couple of years. But I would say if you look across our lineup here at First Trust Invest, you would find that the vast majority of the 100 plus buffer ETFs have a 1-year target outcome period. And so what ends up happening is, let's say that we invest into that product on the reset date or the listing date. And that date for us, the way that we build these portfolios is on the third Friday of the month. Seems kind of random. I don't want to get too granular here, but it's a really important date in the options market, which allows us to have some benefits. Now, when we reset that buffer on that third Friday, and we get into that product on that third Friday, and there's the buffer, there's the cap, we know that. And let's just say we hold it through the 1-year time frame, right? That defined outcome period, that target outcome period. Well, what happens a year later? Well, at the end of that time frame, the S&P, which is that underlying exposure in this example, is going to do whatever it's going to do. Let's use an example where the market went up 10%. And let's say our cap was 15. So we got in, let's say the net asset value of the fund was $10. Over 1 year, if the S&P is up 10, well, now my NAV is $11. On that third Friday, you don't have to do anything. What's going to happen is at that $11 net asset value, we are going to reset. When I say we, I mean our portfolio management team is going to reset the ETF to a new cap and a new buffer for another 1-year time frame, right? And do that into perpetuity. And so what's nice about that for you as the advisor and for the client is that it's hands off, it's very scalable. And also from a tax perspective, none of these products have ever distributed capital gain. So if you keep holding the product year after year, you would be able to have tax efficient growth or tax efficient, obviously, if we're using the buffer, you're not worried about capital gains, but you're able to continue to provide that protection. So that's what happens year over year for these ETFs or quarter over quarter for these ETFs. The last question Would you remind me again, David, just so that I answered
Yeah, no,
properly?
absolutely. We asked about defined outcome period and what happens at the end of that period. So is that when interest is like, again, if the market's up, you know they're going to credit your
Oh, that's
cap.
right.
Yeah.
Yeah, that's right. So you're asking, let's like dig a little bit deeper into the fact that these products aren't going to give you exactly what you expect immediately. Um, so hopefully it's more clear now what happens year over year, right? We're just resetting our hedge, resetting our upside based on where the fund is priced. So there's many different great examples of this on the First Trust website. We've had down markets, you can see exactly what's happened. You've had up markets, you can see exactly what happened. Pick any of the buffer ETFs. It's a really great tool for anybody to go and see whether you're an advisor or a client. Now, to your point, though, to dig into this a little bit deeper, these products are going to provide this performance over time, not right on time. So again, we have a 10% buffer, let's call it. We have upside to a cap, but because of the mechanics of the product, because of what's owned inside of the product, and I like to avoid some of the more granular verbiage for the sake of this conversation, but the way that these underlying constituents of these buffer ETFs behave, there is a time element to it. There's a participation element, but also a time element. And that again is going to react, right? So depending upon your protection level, the more reaction we'll have to what we own. If you have a shallow protection level, we'll see some good participation to the upside early days. We'll see some participation on the downside early days. But what we know, going back to peace of mind, is that let's say that that buffer ETF does have some downside at first and the market doesn't recover, the NAV of the fund will sponge up, to your point, David, sponge up those losses over the course of the target outcome period if we own it from that reset date to the end of the target outcome period. And what's nice about it is this is a product that's going to be a part of a portfolio, is that it's giving you contractual lower volatility. And that's something that everyone's looking for, right? So we've seen ETFs out there, low vol ETFs. We've seen substantial growth in those products during these timeframes where clients need them. But it's hopeful, right? It's hopeful that those low vol stocks perform for us. So what that buffer ETF does is we know that we have a contractual obligation over 1 year. But in the meantime, if we have a 10% allocation in our model, it's going to lower the beta. It's going to lower the volatility for the whole portfolio. So once we understand how they're going to behave, they're actually doing something really nice for the portfolio in the meantime.
Okay. No, that's great. And that's why we have you in here. I mean, I like to tell my clients, I'm going to try to keep it simple for them, but we do have granular clients. They want to know, not just that the light switch turns on, the lights work, but how does the light get to the ceiling? We have those granular clients, so we want to be able to educate them. You mentioned tax benefits. Now, obviously, we're talking about in after-tax individual joint accounts or trust accounts. And I think that for the type of client that we work with, the BAM advisory group, one of their biggest concerns is taxes and retirement, right? I think that's still a big talking point for people that have north of a couple $1 million. You mentioned tax benefits a few times. Let's talk about that, because I think traditionally what we found is that most people own a stock portfolio or a mutual fund portfolio, and every year they're getting capital gains and dividends, taxes. They're not, and they're not really taking money out of it. They're not distributing any of that money to themselves for income. You mentioned tax benefits with these buffered ETFs. How do the buffered ETFs provide more tax benefits versus, let's say, like a mutual fund, for example?
Sure. Yeah, and this speaks more just to the ETF chassis in general. And so what ends up happening, and the way to sort of look at it, and I'm sure these are conversations that you had with your clients, and one of the reasons that we didn't build these ETFs prior to November of 2019 is we couldn't take advantage of some of the benefits that ETFs have as it relates to creating tax efficiency. And getting a little granular, maybe to those engineer type of clients, the doctor type of clients that want to know how the light goes from the switch to the bulb. They'll appreciate this. In the ETF world, when there's a product, right, and there's a bunch of money in the product, let's say there's $100 million in it. and let's say someone sells out of that position. In these ETFs, what ends up happening is there's an authorized participant that sits in between the ETF and someone who wants to own what was in that ETF. So what ends up happening is that there isn't actually a sale of that underlying exposure, creating a capital gain as an example. Instead, it just basically is going to transfer. The ownership is going to transfer to somebody else. So that's how we create tax efficiency in these buffer ETFs, but it's also how tax efficiency is created in ETFs in general, right? Is by basically using what's called an in-kind transfer process where you're taking money out of the ETF, the AP, the authorized participant, find someone else to buy the holdings that were in that ETF. What happens with a mutual fund is that if there's a sale out of it, at the end of the day, the portfolio manager has to sell that position to cash to pay out whoever wants to sell out of the fund. That's going to create a capital gain, which is then going to sit inside of that mutual fund. So that's this general ETF versus mutual funds. But as it relates to buffer ETFs, we needed that to be a possibility for these underlying constituents in the buffer ETF products. The SEC didn't approve that prior to October of 2019. Once that happened, you'll notice we launched our first products because we wanted to create that tax efficiency. There's other nuances, which has led us to create tax efficiency that we've provided at First Trust Invest that other buffer ETF managers haven't provided. But I'll leave it to you, David, if you want me to go that deep into it.
No, I think
get really.
No, I think you do. I think it's simple. Like a traditional ETF in an after-tax account versus a traditional mutual fund just has more tax efficiency based upon what you said, and I think that's a big deal because we've had so many clients walk in our office. They're like, "Can you please tell me why I'm paying so much taxes on this account, after-tax account, and I'm not touching it?" And we look at it, and I don't even have to look at it, but we look at it. But we're meeting with clients. I could already tell you, you must have a lot of mutual funds in your portfolio. What people don't understand is that mutual funds pass through, what we would call phantom capital gains. And that's, and when you're trying to deal with all this IRA money and you have all these other tax problems, I think your advisor should focus on taxes, especially if you're higher net worth. And if they're not, considering, ETFs and some buffered ETFs within the portfolio could potentially help tax efficiency. Now I want to go to a question that will be a little bit funner, not so granular. We've mentioned the S&P as the index. How innovative are these buffered ETFs? Can you choose the NASDAQ? Can you choose the Dow? Can you choose the Russell? Can you choose crypto? How innovative had these buffered ETFs become over the last few years if a client can choose a particular index?
Yeah, like you said, that is, from a product development perspective, been one of the more fun things over the past few years. And I think it's one of those things where you don't want to come to the market with everything off the bat, right? So in 2019, when we started launching these ETFs, we didn't want to just come out with everything before the marketplace was prepared to understand, even what a basic S&P 500 buffer ETF was. So now, though, S&P 500 exposure is a possibility. Tech exposure by way of QQQ is a possibility. We have small caps by way of the Russell is a possibility. We have equal weight S&P. We have emerging markets. We have, like you said, we also have Bitcoin for these products as well. They're a little bit more nuanced the way that we built those, but it's very diverse from an underlying perspective. You could build a buffer ETF model portfolio if you wanted to, because of all the different underlying exposure. And I would say that the product development could continue and the fun could continue, but we like to see what the appetite is first. We like to see what advisors like, what clients like. But yeah, no, it's gotten really fun. And in addition to the different underlying exposures, we've also gotten really creative with the protection levels too. So, we have on the S&P many different levels of protection. 10%, 15%, 100%, a lot of different protection levels, a lot of different underlying exposures. And I think that product development is only going to get more exciting as time goes on.
Yeah, I love that because we get a lot of questions around crypto, and we know how volatile it can be. And we know that you can go get some of these spot ETFs like the one the BlackRock came out with a few
Sure.
years ago. And I think that's up like 30, 35 or 40%. But to be able to own crypto within a buffered ETF, I think may allow clients to potentially think a little bit differently, where they're like, I'm not trying to take on more risk in my portfolio. David, why are you recommending crypto, or what, how should we deal with crypto? Maybe owning it within a buffer where you have some downside protection and still participate in some of that upside might be a way to enter that space, because it's now becoming, it doesn't seem like it's going away anytime soon. And it's definitely a conversation that we're having with our clients. Fun. Yeah, that's the fun stuff, right? We got to have some fun with all this. A question of, hey, if I'm a client, you mentioned this term cost, fees, and expenses. Is there a simple way to explain? Because like we always tell our clients, there's no free lunch. If you're going to own stocks, you're taking on all the risk. If you have too much cash, inflation's going to erode your portfolio. And all of the buffers and the caps all sound good. This again is a strategy where you can have a good protection. On average, the S&P has volatility anywhere between 5 and 15% every single year. But then it gives you the caps sounds like 14. It could be 15%, whatever those are. I know those vary. But what are the cost, fees, and expenses internally to own one of these buffered ETFs?
Yeah, so there's a couple different iterations of the products, but just on average, most of them have a management fee of 85 basis points. So the way that that'll work is much like any other ETF that you own, where basically throughout the course of that target outcome period or that 1 year period, basically you'll see a proration of that expense ratio day over day. So take 85 basis points, is what the fee is, and divide that by however many trading days there are in a year. Let's say that there's, 250 some odd trading days in a year. So every day you'll see a little bit of that proration. What's a little bit nice about the buffer ETFs as it relates to the fees is the transparency. And what I mean by that is that if you've ever looked at any marketing, if you've ever been on a call with a member of the First Trust team that's describing one of these products, and I'm sure David, you obviously describe this to your clients, is you will know what your gross cap is and what your net cap is.
Oh, right. Correct.
You will know what your gross buffer is and your net buffer, right? So there's always going to be an eyes wide open situation where, when I do these monthly calls, oftentimes with Mark and his peers, they'll say, Mike, okay, talk about the September series. What just happened? And I'll say, well, the cap came in at 14%, but your net cap is 13.15. Now, the last thing I'll mention, and again, I guess I can't help myself, but what I will tell you is that our portfolio management team has done a really great job with creating efficiencies through different practices underneath the hood, where we have basically averaged anywhere between 5 to 20 basis points of outperformance out every single reset for every buffer ETF. So point being, there could be a positive surprise. We go in there and say, hey, listen, you're going to have an 85 basis point fee, right? That's essentially worst case scenario here. However, historically, for every buffer ETF, we've had a 1000% average of outperforming, essentially creating a slightly lower cost to the client.
Love to hear that. And if you're watching this, ladies and gentlemen, again, there's no free lunch, but if you understand your portfolio and you have mutual funds, understand your expense. I mean, we sit down with clients all the time that don't understand the underlying expense of their mutual funds, and they're taking on 100% risk in the market. They're paying their advisor 1%, which is national average, which is fair as long as they're doing the good work. And then we see these mutual funds that have 50 basis points, 1.5% extra in fees. And then that's not coming with any protection. So I think, again, that's reasonable. How are the caps? So for someone to understand, who sets the caps? Are they different every month? How are those caps determined? Is it based upon volatility? How would you answer that question?
Yeah. So as far as who sets the caps and what's a little bit different about the asset management world starting to do this as opposed to an annuity at an insurance company or a bank creating those, type of upside, is that the price discovery, the caps are based wholly on what is happening in the marketplace. Essentially what I mean by that is, how much does this level of protection, let's use 10% again as the example, how much is 10% going to cost in its current market environment? Meaning, where do I need to set the cap so that we can essentially fund that downside protection? And to your point, David, it's going to be something that moves around day to day and then month to month, right? So every single day on our website at Vest, we actually have what the caps would look like on that date. Now, to your point, what drives that are going to be things like volatility and interest rates. And the reason is because when we create that cap, it's basically we're selling away something, selling away that upside to get money to fund the downside. So think of it this way. When higher volatility exists, when higher interest rate exists, we get more money from selling away the upside. So in environments where there is higher volatility, environments where there is a higher interest rate environment, when we sell away that upside, we get more money for it. Therefore, your cap will be higher. But nonetheless, those sort of things fluctuate month to month, right? So think back to like April, we came in with a huge cap because that volatility that occurred from March to April during that sell-off, subsequently that April cap was really big. Now through the course of the past however many months we've been in a bull market, volatility's come down. We just had 2 rate cuts. So now that caps are going to be lower than what we saw previously. What I do like to point out though, is there's also this sort of interesting rule where if you notice that caps are starting to come down, that typically means that the market is starting to go up. And that means that we're at all-time highs. So our 14% cap at all-time highs is just as good as a 20% cap back in April, right? Or even worse.
Right.
So right now, 14% cap at all-time highs, where valuations are, that's actually really attractive compared to even a 25% cap 6 months ago, because the S&P has performed above 25% since then. So that's how the caps play out. And then also it brings up a really good point, which is that, it's an interesting time to consider using these products, right? Because, we often tell clients, and there's a lot of lame analogies, but get in the boat at the dock, right? Or don't buy insurance after the flood occurs. But we see that, right? During COVID, when we saw that huge sell-off, we just started bringing these products out and we went from, 0 AUM to 2 billion overnight because of the fear in the market. But that was after the sell-off occurred.
Right.
So it's always good practice to add exposure to these products when we're in the environment that we're in.
Oh, great. That's a great answer. And I've got just a couple more questions. I mean, I feel like you and I could probably do this for a few hours and there's so much, we could go so deep if we want to. We mentioned holding period, generally 12 months. Are there any liquidity considerations or limitations that we haven't addressed that I haven't asked you that we could talk about real quick?
So from a liquidity perspective, we just recently spoke about all the exciting new underlyings that we brought out. The reason that we don't have 100 different underlyings has a lot to do with liquidity. And again, I don't want to get too granular, but what I'll tell you is that First Trust has a very high liquidity standards for us to bring out any product, meaning that the product must have underlying liquidity where we feel comfortable that at any dollar amount, a client can get in and out of the product like they could with the largest ETFs in the industry, like SPYs of the world. So we feel very confident with the underlyings that we have that they're very, very liquid, meaning that you can feel comfortable placing a trade and selling it, placing a trade in and selling out with a lot of liquidity. So from a liquidity perspective, we have a lot of confidence, and that's why we only have 5 to 6 underlyings and not, again, micro caps or something really wonky out there with buffers on them, because they wouldn't have that much liquidity. However, one thing that's sort of related to that question is, as far as when should I sell and, what should I expect, goes back to what we were talking about, which is, when we sell out of these, and let's say that there's been a sell-off and we sell out of this in the middle of the target outcome period, don't expect that you're going to be made whole at that point.
Correct.
Right? The buffer hasn't fully kicked in. It hasn't fully sponged yet. So from a liquidity perspective, from that vantage point, that's something to be sensitive about, right? We haven't gotten our full protection yet. So if we got in at $100 and we're at $95, well, we're selling off with full liquidity, but at $95.
Right. This shouldn't be looked at with short-term money. This is something that, is it fair to say like, hey, you want to have this for at least a year so that you can realize, either the upside or the downside based upon the market's going to do. Is that fair to say?
Yeah, absolutely.
Okay. 2 more questions. We've talked about all the upside, all the downside. is what final piece of advice would you offer for someone, that's considering, let's just say 55-year-old wants to retire in the next 5 to 7 years, understands the market's at all-time highs. This individual really hasn't experienced, a down market in their late 40s or late 50s outside of 2022, really. And that bounced back really quickly, right? Most down markets take a longer time period. What final advice could you offer someone that's, learning about these products? And again, why could they potentially make sense right now at all-time highs and where that person is, 5 to 7 years from retirement?
Yeah, I mean, and maybe we mentioned it already. I think one of the things to think about is where valuations are, relative to where they've been. But I think most important thing, in we sort of has been alluding to this through the course of the conversation. I think for these products, and they're growing rapidly, right? Here at First Trust Invest, we've gone from a standing start of 0 AUM to about 55 billion in about 5 years. But what's so important is just education, right? So just, making sure that you really truly understand what these products do and how they perform, how they behave. If you're not already working with a great advisor like David and the team at BAM, I would highly suggest using a product by way of working with an advisor so that they can be the ones that understand the product and then educate you on it. I think that that's really important. So really integral is really that education. From there, once we understand these products, I don't think there's going to be a lot of disappointment, to your point, David. What I've always noticed, and I've been at the firm, I was the 5th employee thereabouts since 2016. We now have, 55 employees at Vest and, thousands of employees at First Trust. But what I've always noticed with buffer products, the hardest thing to do is to step into them, right? It's like sort of jumping into the pool. You dip your toe in, it's a little cold. Hardest thing to do is just jump right in. What I've noticed is once you've jumped in, clients then appreciate that experience and they don't want to get out. Even with the market doing what they're doing, they still like that a part of their portfolio that they can really rely on. But it takes you to sort of dip your toe in. It takes you to get that education from your advisor or on your own. And I think that's the biggest thing.
A great answer.
It's
Thank
really
you, Michael.
understanding what these products do.
This has been a great conversation. I got one final question for you. At BAM Advisory Group, most people understand that what we do is we build, we like to say at BAM Advisory Group is that most people that have saved money and worked hard for retirement don't have a clear plan to maintain their lifestyle. BAM Advisory Group, we personalize retirement plans so they can maintain their lifestyle and retire with confidence. That's what I think people understand what we do, but really what we're known for at BAM Advisory Group is protecting what's priceless, our clients' time, their energy, their time with their family. If I were to ask Michael Capizzi, if I were to ask you, what does protecting what's priceless mean to you? How would you answer that question?
Well, I think you already mentioned a few of them. Having a 9-month-old daughter and a 3-month-old daughter, a lot of that is protecting time, especially in a really busy time. I go away for a couple of days and it's amazing to see just the growth from those young ladies just over that period of time. So I'm definitely in a phase of my life where my family time is priceless to me, but I also have, I also balance that with a job that includes a lot of travel. So really for me, protecting what's priceless is that time that I have at home with the family. And then also, what protecting is what priceless. This is going more towards the work side of things. Again, this was something, we had 2 co-founders here at Vest, and we've really built something special with our friends at First Trust, I think. And that's priceless to me because it wasn't like I just joined on a firm that had been around for many, many years. And I'm not pointing this out for negative reasons, but a firm like a Vanguard or a BlackRock or a Fidelity, I was really a part of this from sort of the jump. And so I want to protect this too, right? And having conversations like this is what helps protect it. Because if we go out and these products are out there for everyone and they don't understand them, there could be risks involved in that. So this is why this is so important. So 2 different things, which is priceless to me, which is the continued, growth of what we've built here and working with great firms like BAM, great advisors like you. That's priceless to me because 7 years ago, no one was picking up my phone calls. And then also my time with my family, given where my children are in their age, and I'm sure I'll feel this way through their entire life. But that's something that's really priceless to me as well.
Well, you're a celebrity, man. Now we're trying to hunt you down. Well, hey, I love the
I don't
answer
know
to
about
that. I love the answer to that. I think that's one of the best answers we've got from our guests. No offense to our other wonderful guests. That was well thought out. I love the mix between family and business. Michael, just really want to thank you for your time, your education, educating our audience, because, as we get to, we don't want the market to fall apart. Last time it did, it was 08, 09. I can remember exactly. Those were dark days, but I really appreciate the relationship with Vest and First Trust and all what you're doing. I think you're changing the industry a little bit, providing clients more options. And again, just wanted to thank you for your time and your words and education today. Our audience is really gonna love this.
I can't thank you enough, dude. This has been such a cool experience. I really appreciate it. Any other way that we can support BAM and support you, we're here to do so. So thank you so much. And I hope your clients enjoyed the conversation. I certainly did.
If you're curious about how we help people protect what matters most in their retirement, and you just want to see how our process works for you, give us a call or visit our website at www.bamadvisorygroup.com. You can schedule a 15-minute, no cost, no obligation, no pressure phone call with one of our advisors to get all of your questions answered, to understand your options, and for us to be able to provide you with more information and clarity. And if you're enjoying the show, don't forget to like and subscribe. Thanks again for watching. We'll see you all real soon.